Hello and welcome to this session brought to you by the Academy of Practical Accounts in conjunction with your institution. In this session, we look at income and non-incomes. How do we differentiate between the two? Please note that this is probably a by the way because the Revenue and Customs authorities in UK have simplified the process in that all income can be grouped together on the tax return. So we don't have to know the differences, provided we are able to differentiate between an income and an expense. That's what matters. Anyway, brief look. Now on the left hand side, we've got incomes. Now an income is that money which increases the profit of the business. Most obvious is the sale of goods and then services. However, an income refund reduces these two, and they should go directly to the same accounts. There's nothing like a sales return account. No, that negative value reduces whatever is recorded onto these, as we shall see in the next session. Now, we also have bank interest. Some money that we received from the bank, in addition to what was deposited or the balance on the account. And the reasoning is that the bank has lent out this money, and from the interest the bank received, part of that interest is paid to the business or the money owner. That's the bank interest. And then commission is money earned as a reward for selling on behalf of another business or individual. A common example is selling airtime, or that's airtime, or subscriptions, monthly subscriptions for mobile services, mobile phones. We've got the O2 in UK. We've got T-Mobile. We have Virgin Mobile. We have Orange, and then we have MTN that is common. And then we have rent income, which is received from renting out part of the premises of the business. And then any income that doesn't fall in these categories ideally should be classified under any other income. Now on the right hand side, we've got non-income receipts. Money received that doesn't increase the profit of a business. It doesn't increase the profit, it doesn't increase the tax. Money capital. This is money contributed by the owner to the business. The business cannot run without money to start with. If it's a buying and selling business, we need capital to buy the stock before the stock can be sold. So that's money capital. Then we have VAT and PAYE refund. Now, VAT refund applies to businesses which are registered for VAT. In the UK at the moment, it's £82,000. Any business whose turnover is below that should not register for VAT unless otherwise. So that VAT refund arises when the business pays more on what it uses in the business or sells than the VAT recovered on sales. The VAT recovered on sales is known as output VAT, and the VAT paid on purchases for the business is known as input VAT. So if output VAT is more than input VAT, then the difference is paid to the VAT authorities. If input VAT is bigger than output VAT, then the business gets a refund. PAYE refund is not common. That is when the business is refunded for some reason. The PAYE paid was probably more than should have been paid. Then we have agency collections. We've talked about mobile phone businesses, which are very common these days. Now, businesses sell on behalf of mobile businesses, and then we also have electricity services, gas being sold, and water on behalf of the big companies. So the money collected for those big companies is not an income. The income in that particular respect should be the commission. There's a commission that is received for every 100 that is sold. For example, it could be 2%, 5%, it depends and varies. And then miscellaneous receipts, we got rent deposit. A rent deposit is a refund received from the tenant when the business is vacating premises, and the initial deposit to cater for damages to property is paid back to the business because there was no damage, or it's in excess of the amount deducted for the damage to the property. Now, insurance is a little bit complex because premiums are paid out and then a compensation is received at some stage. It's a little bit complicated. Now, data payments is not an income in the traditional accounting sense. We got traditional accounting and then we have cash accounting. So, in the traditional accounting sense, income is recognized at the time of credit sale. Now, when that debtor pays at a later stage, that is not income. That is a debt being cleared. Now, the sales of fixed assets is also tricky and not outright. In that, when a fixed asset is bought, it remains on the balance sheet and then at some stage it's written off in form of depreciation, which is not allowed for taxes, and instead written off in form of capital allowances or tax allowances. So this one is also tricky. And then finally, we've got borrowed money in form of loans and overdrafts. So when money is borrowed, the income of the business does not go up. That is a debt to either a bank or the lender. It is also not income. Those are the broad classifications. Now let's have a very brief look at our chart of accounts. Chart of accounts is supposed to be looked at in a later session. Now the first two groups, we've got turnover and other income, but then I need to remind you that we now have a provision of recording all the income on this income account number 5. Income account number 5, all income can be recorded there. Now the income accounts is only from number 1 up to 20. For a business whose turnover is above 82,000 in the UK, you can use all these 20 accounts. But if the business is small, account number 5 is sufficient. Anyway, so account number 1 to 10 are turnover accounts. We've got the sales account, we've got the fees account, and then of course the all income account. And then the second classification is for the other incomes. Now in this case, we've got commission income, rent income, interest income, insurance compensation, other income, and then we have a capital allowance balancing charge, which is a little bit complicated for tax purposes, tax adjustments, and then we've got number 20 for temporary income. In case we don't know in which classification to record the income, we can use the temporary income. However, in this case, we're only using one income account and this one doesn't apply. Well, that brings us to the end of this session where we'll briefly look at the differentiation between incomes and non-incomes. Thank you.